Welcome to Financial Inclusion Week 2025. My colleagues and I are very excited to present our paper to you today, titled Beyond Traditional Metrics, a Holistic Approach to Understanding Over-Indebtedness and Financial Health. My name is Ricardo Lopez. I am the Regional Director for GeoPoll. I'm joined with our Technical Advisor, Dr. Anastasia Mazoyans, and our Chief of Staff, Donna Lee Ginsberg. But before we start, we've posted a little question in the chat. How many loans do you think the average Kenyan digital borrower takes in a year? If you can take 10 seconds and just give me the answer in the chat, I guarantee you it will surprise you. We're not going to do this anything quantitatively, and just if you want to make a mental note, write it down, do so now. The answer is an average of 29, and more surprisingly, some respondents report up to 278 loans taken per year. The source there is at the bottom, and we'll go into greater detail of this report that we have authored. What we'd like to share with you today, though, is who we are and what we do, what we know about the over-indebtedness paradox, ideation around additional data and its application to credit scoring models, as well as what we plan to do next and how you can get involved. So who we are, GeoPoll is a market research firm. We specialize in reaching underserved respondents and beneficiaries at the last mile. We've run various research projects within financial inclusion. Most notably, though, over the last 10 years, we've conducted impact surveys for fintech companies and micro lenders in 9 countries, completing more than 100,000 surveys through SMS and Caddy. Now, we are able to achieve this because of a mobile-first approach. It is simple yet scalable, and it leans to the familiar low-tech environments that respondents are comfortable with. So we're no stranger to the impact credit has to its users at the last mile. I mean, for many customers, it's the difference between paying school fees or not, buying stock for a small or micro business, or paying for essential goods and services. Now, if we have to look at just one challenge experienced by financial service providers as an example, it would be an inadequate risk assessment and credit scoring model due to limited documentation, literacy, and language challenges. So what we've noted is that some fintechs and FSPs are innovating here. I mean, some app-based providers, build risk profiles from smartphone OS data, like app and phone usage. Others try to pull in deeper phone data, such as model type, and some go as far as actually viewing SMS messages. These innovations, although innovations, are just not enough, and they also come with risks, right? Apple and Google can change their policies and shut off access, for instance. Pulling personal messages crosses or pushes the boundaries on privacy concerns. Yet the biggest challenge is excluding users in low-tech environments. So we think that the one thing that works across low and hi-fi is voice. And today, my colleagues and I will unpack this idea further. We'll share our foundational research on over-indebtedness and some early ideation on voice data analysis added to quantitative metrics, which can uncover any additional sentiment that the traditional numbers might miss. I'm going to hand over to my colleague, Anna, who's going to talk about what we know about the over-indebtedness paradox.
Oops. Great. Hello, everybody, and thank you for joining our session. My name is Dr. Anastasia Mazoyans. I've been working in the sector of financial inclusion since 2009 as the research director on financial tracker survey in Tanzania, Uganda, and Pakistan, when we were just uncovering how mobile money can impact the impoverished households. Then to Financial Inclusion Insights program that covered 16 countries between 2013 and 2018. It's really exciting to see how far the sector moved in the last 15 years. Just that I've been working here and to look at financial inclusion and also the financial space from all the different perspectives and look for innovative approaches to include people into growing their economies that we're talking about today. So I'm going to talk about the most recent study that we've done with GeoPoll on the behalf of GSMA, looking at over-indebtedness in 5 markets in Africa and Asia. Next slide, please. So first, a little bit about the study. We looked at 5 markets, as I mentioned: Cote d'Ivoire, Ghana, Kenya, Tanzania, and India. And the overall project was inspired by a true concern that the digital credit has been available in multiple markets from the early 2000s, 2010s. But we are only seeing incremental positive changes, and many of those changes are not sustainable. And we're not seeing the big shifts that we were hoping to see with more accessible credit. So overall, the objective of this study was to understand the 5 markets and understand them from multiple perspectives. So look at regulatory environments, look at what products are available in the market, talk to the consumers, talk to the experts and the providers in those markets, and understand, first of all, what does digital credit do for people, how it compares to traditional credit, and also what can we learn from those markets and how can we move the needle in terms of taking more opportunities for growth. We used mixed methodology, so we've surveyed about 3,000 people across the 5 markets, and then we talked to multiple regulators, providers, and the experts in the digital space. All of that was based on very rigorous literature review. Moving to the next slide, the key learnings from this study were that the relationships between digital credit, traditional credit, and over-indebtedness and financial health are rather complex, and they vary quite a lot by market, depending on the context, the landscape of the market, the traditions, the cultural behaviors, and many, many other things. But what we saw, for example, there was a huge diversity of borrowers. Starting from, for example, an Indian borrower who is very conservative, takes about 1, maximum maybe 2 loans a year from very reputable formal institution, and uses it for really big life-changing expenses. So wedding, maybe a funeral, things that are really big and really require quite a bit of investment. They have very low delinquency rates and overall are quite responsible in how they manage credit. Going to all the way to, for example, Kenyan borrowers that we mentioned at the beginning of this presentation, with average Kenyan loan borrower having 29 loans a year from multiple providers. So that's more than 2 loans, 2.5 loans a month. From a range of providers, from digital credit lenders to MNOs, to neighbors and friends, to their own employers, and many, many more. We also saw that the delinquency rates, especially in Africa, were quite high. So East Africa was topping the charts with 86% of Kenyan borrowers, for example, reporting loans at different stages of delinquency, from 1 missed payment to some partial payments to loans that they stopped paying off altogether. Tanzania was right behind it with 70% delinquencies. Ghana and Cote d'Ivoire were doing better, but still the rates were over 50% with those who reported non-repaying their loans. We also saw that the repayment challenges, the conversations around repayment challenges, are quite circular in all 5 countries, and kind of go back to the reason people took the money to begin with. Having shortage of money to pay for basics, for food and transportation, for example, to the job place, were some of the key drivers. And then the increase of costs of those services or those products what the reason that people were not repaying loans. So basically what we saw is that the reason you took the loan was also the reason that you didn't repay the loan on time and in full. We also saw quite a lot of conversations around coping mechanisms, and coping mechanisms ranging from people dipping into their savings if they had any, depleting their emergency funds, taking children out of school to repay the loans, but also working harder, working more hours to actually earn more. So overall, the findings were quite mixed. On the one hand, we did see positive changes due to the credit, especially the accessible digital credit. On the other hand, we've seen quite a lot of the same challenges being repeated, but now at a much more difficult level because people had loans and loans at different stages of delinquency. So if we go to the next slide, what we've done in that study that kind of made it an experiment for us, and really interesting learning experiment. We used 3 different approaches to measure over-indebtedness. So we looked at self-report. We asked people, borrowers in the survey, if they have missed payments, partial payments, and loans that they stop paying, and use that as one metric of over-indebtedness. We also looked at the debt-to-income ratio, and not just the income specifically and that overall, but the income and the amount that they have to repay every month to cover the loans. And then the third one was the Adapted Human Suffering Index. So we basically used the index that was originally developed by UNDP to understand the level of human suffering in uncertain and conflict, fragile situations, and adapted it to understand whether the repayment of loans deepened the human suffering in these countries and had people go without food, for example, or other basic expenses. So that allowed us to look at over-indebtedness and debt and what that does to the household from multiple perspectives. And what we found was really interesting and kind of puzzling. We've seen that people who were carrying digital debt were more likely to report loans in delinquencies. But at the same time, when we asked them about their financial health was at least at the same level and sometimes better than those who didn't have loans in delinquency and was borrowing from traditional resources. And another puzzling finding, next slide, was that we saw that people with higher delinquency rates also had higher rates of savings account reports, and they were able to contribute to those savings accounts on the monthly basis at the higher rates. So going to the next slide, just to summarize what we called internally the over-indebtedness paradox, was that we did see digital borrowers to be more likely to report loans at different stages on delinquency and having multiple loans kind of falling as domino through the delinquency stages. But at the same time, they also had savings, and they had quite healthy savings and were contributing to those savings on a regular basis. They also had quite healthy rates of financial health, sorry for the pun, sometimes even better than those who didn't have loans in delinquencies. And finally, digital borrowers with high delinquency rates also believe that digital loans help them to address not just their immediate needs for food and other basics, but also boosted their economic growth long term. So having consulted, next slide please, with the experts and the providers, we arrived at these 3 learnings, again, as to why this gap in understanding might be happening, why we are assessing, it seems to us that we're assessing over-indebtedness from multiple perspectives, and we're getting comprehensive picture, yet the picture is misaligned with our expectations. So one of the challenges that we saw and that we want to address in this presentation is the lack of comprehensive data. So yes, we do have the data, but we rely on objective data and objective numbers in situations where we also talk about quite a bit of subjective feelings. People feel that the loans are helping them. People feel that they're doing much better because of the loans, and they don't feel bad about being delinquent. For example, we also kind of arrived at the conclusion that the definition of over-indebtedness and debt is not very clear or not very uniform, because there is different understanding of what constitutes delinquency. Is it just one missed payment, or is it multiple loans that the person defaulted on? And there is the difference in perspective from both the borrower and the lender sides. And then the third learning on our side was that we often see lenders relying heavily on one specific metric that is practical, that is workable, but give them only a small picture or a small perspective on what's going on. So on the next slide, the reason that we're bringing this up, and we believe this is a concern, because we see missed opportunities. So in that particular study, we saw the missed opportunities of including two really large segments that have a really strong potential to boost the economies and stimulate economic growth. So one of them was aspiring middle-class buyers. We saw that a lot in India, specifically less so in East Africa, but also we see that in West Africa, Cote d'Ivoire and Ghana, where middle-class employed workers really want to buy products and services that would signal their transition from lower income classes to middle and maybe even low upper class, but they don't have the proper credit history to buy those products and services. Yet buying those would stimulate production of such products and services and stimulate employment. The second really large group is informal growing small and medium enterprises. There's quite a bit of lending that's happening with micro enterprises, especially informal micro enterprises, but informal small enterprises at the stages of growth where they can signal over-indebtedness, for example, are not as lucky, and similarly, micro enterprises that want to transition from informal to a formal stage and start hiring workers and creating employments also have limited access to proper finances that are tailored to their needs. And in our other research in East Africa, we saw that, for example, as little as $50 in credit on the conditions tailored to such micro enterprises can boost them to the stage where they start hiring workers. So, and the third group that we're bringing also in this presentation is the group that is not included in the economic space because of their linguistic challenges. Either they don't have a written language or their language is not part of the formal financial system. So there are millions of people who are not participating currently because of those challenges. And as a result, as I said, we're looking at missed opportunities for economic growth, at funding such opportunities and boosting the economies in the situation where we're facing a lot of uncertainties and want to create resilience and boost the growth. With that, I'm going to pass the baton on to Donna Lee, my colleague, who will talk about the potential solutions we're thinking about. Thank you.
Thank you very much, Anna. I appreciate it. Hi, everyone. My name is Donna Lee, Chief of Staff of GeoPoll, but I also lead the AI data streams initiative that we're running at GeoPoll. And I guess, after looking at the results from the GSMA study, we realized how much value this new technology that AI is bringing can add to the financial inclusion space. And that's what we want to talk to you about today. Some concepts that we've been exploring around voice from a research perspective, but also how it applies to both borrowers and lenders. So the whole concept of adding a layer of voice analysis to traditional credit scoring or credit analysis is that we believe that borrowing needs to fuel opportunity and not substance. It's too easy potentially for people to apply for loans on digital platforms without having the correct assessment of their financial position, not only from the lender itself, but also from their own assessment of their situation. But what we're going to be focusing on in this presentation is particularly three populations that we believe are left out of the lending system, and that could quite easily be included productively with voice-enhanced technology. And the idea of this was born out of a friend of ours who is a farmer in Zambia. And he runs a really, really productive farm, but he cannot take the farm to the next level without a tractor. And he doesn't have any filings under his name at the moment to apply for credit. So what he needs to do is that he needs to save very slowly every month in order to buy the tractor and to make his farm more productive. If you had to listen to this gentleman speaking, you would understand that his business is thriving, that he manages the downturns really well, that when he has the tractor within his business, that the loan would turn productive and he would very successfully be able to repay the loan for this capital into his informal business. So this is one of the many inspirations that really made us think, well, how would we be able to include a gentleman like this who falls under one of the population segments that we're talking about today? So as Anna mentioned, we already spoke about the three population segments that we really want to focus on bringing productive lending to. The first is the aspirational middle class, those that already have an income and manage to pay their general expenses, but are looking to create more mobility and flexibility in their life. The second is the informal MSMEs, which make up 80 to 90% of the developing the developing economy, and really is the fuel of the developing world. And then something very dear to our hearts at GeoPoll is the linguistically excluded, and I'll explain why a little later on. But the point is that if we take the Zambian farmer example, without any credit rating or without any data on whether or not he will repay his loan or not, and even with limited data about his business, it's very risky for a lender to be able to assist him with his business. But if we were to develop a interviewing technique using AI, voice analytics, behavioral analytics, maybe even at a later stage an AI agent, so that he would be able to speak to someone that's less human, and therefore they could be a bit more open, and the responses can be analyzed that way. These populations can be included into the financial systems, and the prosperity and the economy of these populations can grow. So the grounding around why we are really inspired to investigate this further is that we know that productive borrowing is transformative, that digital credit is necessary, and it really drives mobility when it's lent to future income and not just short-term consumption. We also know that over-indebtedness goes beyond the problem of defaulting, and that the world we live in, the populations are facing high cost of living. They have very low to no fragile safety nets, and we need effective models to really understand these contexts better. And we believe that analyzing the way someone answers a question, how they answer it, what they say is the key to that. And then also, when having conversations with people, you really understand about what they intend to do in the future versus looking at only quantitative data that's happened in the past. So it's moving from only looking at default to looking at a dynamic future that has far more potential for the populations and for the economy. So some of the existing tools that have inspired us and that we'd love to build on, Safaricom and Investec are already using biometrics to use voice as an identity. So the voice is already being included in financial and mobile money. Voice as an insight, it's something we're doing at GeoPoll in terms of what we're doing is we're developing an ASR speech-to-text model to automatically transcribe our surveys. Like if we had this technology back then and we built it on the GSMA study, when we do the study, we'd automatically get a transcript. We'd be able to analyze the content immediately, as well as analyze how a respondent actually responded to the survey. So some of the points that Anna was making about respondents saying that they felt financially healthy. How did they say that? Did they sound positive? And then you compare that across a sample, and if you overlay that with other data, we can really get a better understanding, a more holistic understanding about the borrower. And then also other studies that CFI have undertaken with Pesesha in both Brazil and in Kenya, introducing positive friction. That's 3 questions at the beginning of a lending process that just make the borrower think twice whilst they're applying for this digital credit. This can be done from a voice basis too. And what I like to say is that sometimes people don't know what they're thinking until they say it. So by introducing a voice analysis or a voice interview at scale, this could really make populations think twice about how they will use the money and make them more productive in using the loans and generate positive economic benefit. So the tool that we're developing, what we've done is over the last decade, we've collected over 1.4 million voice interviews across 1 million individuals and 100 languages. It's incredible. So what we're doing with this voice data is we're starting to, as I mentioned, we're developing an automatic speech recognition model. And what we've done is we've tested that on the food security research that we do in Latin America. This food security research is done via CATI on a daily basis to understand where the populations, the beneficiaries are at in terms of their food security. What food groups are they consuming, how much, and are they at risk? It's all quantitative survey data. What we did is we took 4 qualitative questions, we added it to the quantitative survey, and did this test across 2 countries, in El Salvador and Honduras. And the results were incredible. We learned more about this handful, was about around 30 beneficiaries. We learned more about the sample of beneficiaries than we ever would have known from only looking at the quantitative data. And it wasn't just looking at the purely transcribed response of what they said in the qualitative questions. It was also how they said it, the size they took, the pauses, finding it difficult to answer questions about how they feed their family. But if you looked at the quantitative data on that person, quantitatively they're actually above the threshold, and they're considered okay. So that was really, really fascinating, and that's really inspired us to take the voice analytics further into all research that we do, and also to work with institutions in order to develop more advanced voice analytic tools. So the rest of the presentation, I don't want to take too much time because I do think I'm a little bit over, but we do go into a bit more detail about each population group. So the middle class, like I mentioned, those that already can pay their bills. It's about understanding what is reliability for this population group. So defining new metrics beyond just a pure credit rating score, because they probably have some form of credit score, but how can we bolster their position in the market by offering them more productive loans? The informal sector make up 80 to 90% of enterprises. They fuel the economy, but most of them are unseen. They are small entrepreneurs that are incredibly productive, but completely invisible to many businesses. So by having conversations with these informal businesses and formalizing those conversations and adding layers of assessment onto their voice responses, this turns their informality into something that's really, really investable and productive. Similarly, in the case of the Zambian farmer, who would very likely repay the loan for his tractor and grow his business significantly, and could end up actually hiring more people. From a linguistic perspective, Anna spoke to this already. I'm just giving a couple of examples here, but there are many, many populations in the world who literally cannot speak the language that the financial institutions operate within in their country. Hausa, it's widely spoken, but it's one of Africa's largest informal economies, and it's completely digitally invisible. There are very few or limited Hausa AI analysis and voice analytics tools available, as we would expect. But this is an economy that would highly benefit from these conversational agents that could be developed to bring more financial productivity to this population. Similarly, in Haiti, where most of the financial institutions are spoken in French, but much of the population can only speak Creole. In the West African Francophone region, where the dialects are diverse, but it's a critical region for agriculture and micro businesses, so developing tools and techniques for analyzing conversations in their local dialects to really get an understanding about who they are is critical. And also for diaspora communities who are, despite being in diaspora communities, are running really vibrant economies, but they have really limited access to formal credit. Speaking their language is a way not only to give them access, but to give them agency. So the point of what we're proposing here, and kind of the call to partner with us on this journey of voice analytics for these populations, it's about giving populations that would never have access to loans, but also to give them agency. It's building tools that really listen, and it's also about building equitable design, so design that includes everybody and not just a few. I'm going to hand you over now to Ricardo, who's going to talk about some next steps.
Thank you. So, what we plan to do, and basically our call to action really to the entire financial services ecosystem is really for partnership. Firstly, with lenders, we are inviting lenders to co-design and test pilots with their own customer groups. We're particularly interested about running random controlled trials to various subsets of those user profiles. For academics, it's really around assisting us fill in the blanks, any kind of baseline metrics that you can assist on, assist with error testing, bias, as well as improving any kind of model that is developed. Regardless, like Donna mentioned on that very impressive screen of 1.4 million interviews, we've got terabytes of audio data that can be used for a multitude of analysis, not only within financial inclusion, but really across a wider range, a spectrum of development issues. In terms of the development sector, we do want to support fairer credit expansion, but we do at the same time also want to talk in the same breath of smarter and more well-informed consumer protection strategies. And then policymakers and regulators, I think, is really the biggest one, where we want to build any kind of ideation inside a very safe and transparent toolkit. We don't want to have anything, in a black box. So renewing or reviewing the fairness of our models before anything is scaled is absolutely vital. I don't know how I'm doing on time, but next slide, it really covers some of the ethical and regulatory considerations that we've made. Voice data is personal. It's often biometric. So it's critical that users stay clearly, are clearly informed as to how this data will be utilized and recorded. And it's important that if any action is taken because of voice or AI data analysis, it's backed up by a clear explanation. We want to improve accuracy and reliance over time and be cognizant of that, as well as the user anonymity and dignity. And then there's the regulatory compliance and security, which as a research organization is something that is really part and parcel with the services that we deliver to a lot of our clients. So we are thinking in terms of how do we make this sustainable? How do we make it ethical and compliant? Last page just covers some of the references on the research that we've conducted to get to this point. Please feel free to have a look. And if there is time for questions, we'll take them now. Otherwise, we'll definitely circle back to all the questions posted in the group, make sure we close this chapter off. Thank you very much for your time.
Thank you, Ricardo. I'm not sure if people can ask questions live or if we need to read them from the question box.
Let's see which ones are unanswered.
I think I answered the questions. So if anybody is interested in posting more questions, we can answer them. But one of the questions that I think many would be interested and probably have the same question. So we're seeing really high rates of delinquencies. So the question was probably some of the borrowers just don't feel the pain of the repayment, and that might explain why we're seeing such high delinquency rates. So with that, our hypothesis or our information that we have through our research is that the regulatory system is definitely catching up. So prior to, well, maybe a few years ago, if you borrow from a lender like Tala and you never repay, there are no consequences. These days, you definitely feel the consequences with being blacklisted by the consumer boards across multiple countries. You're not able to borrow again, at least until you clear your existing loans. We're currently working on a small study with small and micro entrepreneurs, informal micro entrepreneurs who are facing that challenge, that they're applying for a loan for their business, but it turns out that a couple of years ago they took a Tala loan from Tala and they never repaid. So now they can't take a loan to buy a motorcycle and start a border business, for example, a delivery business of sorts. So the consequences are definitely there, but we think we're also missing out on a very nuanced and detailed picture of how people use those loans and how they're actually thinking about repayment. Because in multiple cultures in Africa, for example, borrowing from your friends and family and relatives and the village is quite common, but the repayment scheme can vary quite a lot. So you can repay, for example, a loan that you took for studies in college 10 years later by helping somebody of getting their child into that college. So the repayment can be very slow and it can be in kind, not necessarily in money. So a lot of people who come into the formal borrowing system are coming with that mindset. So they are repaying, but they're not repaying on the terms that the lender set out. But more interesting, there is really nuanced way of how they're using the loans while building their financial health and while building their savings and their emergency funds. So that's where we feel there is a gap and we really want to explore. I hope I answer that.
Thank you, Anna. I'm going to take a question from Natasa around our voice solutions, just to give a bit more background about where we're at as GeoPoll. Obviously, our background being, and at the core of our business being a research business, where we're focusing on our voice analytics at the moment is from an insight perspective, speech to text, qual at scale. But we're also working with companies to develop voice models, and in other words, develop model LLMs that can speak the various languages that we've collected data on. We're also looking into voice enumeration across these languages. These will all take time to develop. So currently we're in an ideation stage on the advanced voice analytics specifically for credit scoring. But from a research perspective, voice analytics at scale, that's where we've started. And of course, with all these technologies, there are new tools and new ways of doing things every day. So we're very, very excited about the space and really, really excited about the humanness that we're able to understand at scale now that we never would have had before.
Cool, thanks. I'll take a question from Isabella. Asking, what is your experience? What has been your experience with respondents' reactions to speaking with AI? Do they express skepticism or discomfort with technology? Do you call them directly to their phone numbers? So we don't do any surveying initially on using AI agents or AI chat. We have large computer-assisted telephonic interviewing call centers and remote dialers who actually use either predefined respondent lists or through random digit dialing actually reach those respondents for interviewing. So we don't include any AI right now. What has been a technology that has been utilized in the past is IVR, which is a little bit not as functional as what the new AI agents are, but it has its place. It's you know, when we do research that covers very sensitive topics, if we're covering maybe topics related to piracy, let's say, or topics related to sexual orientation in countries where that might be illegal, we generally find that remote data collection, where a respondent is not disclosing sensitive information to an actual live person, they elicit a lot more truthful responses. So I do believe it'll have its place, particularly in the same, you know, maybe realm of disclosing sensitive financial information, even though they are aware and they are consented to disclose this information that is potentially sensitive. That generally, you know, what we find in a lot of studies is that when we do ask an income question, that is somewhat inflated, right? We always need to tone it down, or tone the answer down a bit, because we do know that the majority of these answers are slightly inflated around what the truth is. So I do believe it has its place, but that's not really the mode of data collection that we utilize. I hope that answered your question, Isabella.
Okay, I can take a question from Fiona. That probably will be...
Yeah, sounds good.
So the question is, what about competitive markets where a formal financial system is developed and regulated, yet there exists a prolific informal lending sector that's not subject to regulations, and the informal money lenders can often be more aggressive in seeking funds to be repaid? Do you have experience with the tension between formal and informal financial sector, and how this impacts over-indebtedness? So in our study, we've seen people borrowing from formal, informal lenders, and also the gray areas. With the informal lenders, they used to be more prominent before the appearance of or emergence of the digital credit sector. They definitely used to play quite a significant role, but in the past 15 years, we've seen them kind of scaling back, and people actually shying away from borrowing from such lenders. Part of that is the fact that when you borrow from an actual human who is an actual informal lender and who is not part of your immediate social circle, these people know who you are, basically, and they can find you, and they can apply their aggressive collection methods to you, which feels these days kind of risky and unnecessarily risky, when you can borrow from, again, somebody like Tala and Branch, and then change your phone and wait for them to find you. And by the time they find you, maybe you already have resources to repay. So there is a completely different dynamic, and in fact, the digital services seem to be winning over the informal lenders. Again, I repeat myself, the lenders who are not part of your social circle, who are not friends and family. So we saw in our study people borrowing much less than they used to from such lenders. So actually the formal sector seems to be winning. We just need to equip the formal sector with more tools to understand the productive use of that a little bit more. I hope that answers the question.
I just want to say thank you very much for your time, and please enjoy the rest of the conference.
Yes.
Yes, we're at time. Thank you very much for your time and for all of the questions and attention to our presentation. We appreciate that, and we hope some of you will reach out to be part of our next steps in development.
Absolutely. Thank you, Anna. Thank you, Ricardo.